Malaysia saw economic growth moderate to 4.3% in 2019, the slowest since the global financial crisis of 2009. That compares with the government's projection of 4.7%. According to Bank Negara's statistics, economic expansion in the final quarter of last year slowed to 3.6%, making it the weakest in the 41 quarters since the third quarter of 2009. Bank Negara Governor Datuk Nur Syamsiah Muhammad Yunos explains that last year's annual growth was adversely affected by supply disruptions, especially in the commodity sector. Looking ahead, she expects the COVID-19 outbreak to put more pressure on the domestic economy, particularly in the first quarter of 2020. She says it's not all gloom, as the economy is still being supported by very firm private sector spending, while private investment might turn around. Still, there are downside risks, and she points out that it is very difficult to predict how long it will take before the virus is contained. Nur Syamsiah adds that there is ample room to adjust the overnight policy rate since inflation is still low. Putrajaya is expecting the economy to expand by 4.8% this year. During the SARS outbreak in 2003, Malaysia recorded 5.9% GDP growth. In 2015, during the MERS epidemic, the economy grew by 5.1%. The central bank's remark about having ample room for another rate cut sent banking stocks tumbling today. Decliners were led by Hong Leong Bank, which fell by 4.3% to 15 ringgit 44 sen, and Public Bank, which ended trading 2.8% lower at 17 ringgit 78 sen. Maybank was down by 0.9% at 8 ringgit 46 sen. CIMB closed 2.6% lower at 4 ringgit 95 sen. RHB Bank slipped by 1.9% to 5 ringgit 61 sen. BIMB fell 3.9% to 3 ringgit 75 sen, and Alliance Bank ended the day down 2% at 2 ringgit 40 sen. According to OCBC Bank research, the rate cut could come after Bank Negara's meeting next month on March 3rd, especially if the commodities production does not pick up. Meanwhile, a local analyst told The Edge that while a cut in the overnight policy rate is not seen as a positive development for the lenders, the net impact to the overall sector is not necessarily significant. The analyst explains that at the end of the day, the banks will get to revise their deposit rates, so the net impact to their margins will not be too major. Assuming there are 2 rate cuts this year, the analyst says earnings will be hit by 4 to 6% on average for the overall sector. Bank Negara trimmed the key interest rate to 2.75% in January. The rate is now at its lowest point since March 2011. The EPF has ceased to be a substantial shareholder of beleaguered budget carrier AirAsia Group. In a filing with Bursa Malaysia, the airline group said the retirement fund disposed of some 18.56 million shares on February 6th, bringing down its interest to less than 5%. EPF's stake in AirAsia had already shrunk to 5.33% prior to this disposal, after it started paring down its shareholding since last month. The start of the sell-off was possibly triggered by the COVID-19 outbreak in December that has been viewed by many aviation analysts as adversely affecting air travel. On top of that, news broke earlier this month of the corruption and bribery allegations against AirAsia, AirAsia'S and Airbus, involving $50 million or 204.8 million ringgit. AirAsia ended today 2.4% lower at 1 ringgit 20, while its long-haul sister company was unchanged at 13 sen. Malaysia Marine and Heavy Engineering, or MHB, swung back to profit in the fourth quarter of FY19 as its marine segment turned positive. The group reported earnings of 9.3 million ringgit compared with a net loss of 25.2 million ringgit a year ago, marking its first profitable quarter since end 2017. Top line rose by a marginal 0.88% to 275.6 million ringgit, dragged down by a decline in heavy engineering revenue. The improved quarterly performance helped MHB narrow its net loss for the full year to 34.2 million ringgit from 122.7 million ringgit previously, while revenue rose 3.6% to 1.01 billion ringgit. MHB MD and CEO Wan Masjida Wan Abdullah Sani says the outlook is expected to remain uncertain in light of continuing sluggish global economic growth, geopolitical instability, oil demand disruptions, growth in US shale oil production and the intensifying COVID-19 outbreak. Still, the group is cautiously optimistic on the prospects for its marine business, with the expected global LNG expansion driven by an increase in exports from Qatar, Australia, Russia and the US to the Asia-Pacific market. Grab Holdings, along with subsidiaries GrabCar and MyTaxi, is challenging a proposed decision by MyCC to fine the company 86.77 million ringgit for breaching anti-competition laws. MyCC's counsel Datuk Lim Chi Wee of Scrine Advocates and Solicitors told The Edge that the hearing has been set for March 9th. According to court documents cited by The Edge, Grab has applied for a judicial review and has challenged the Commission's proposed decision on the grounds that MyCC does not have the authority to make the proposed decision. It also said that MyCC had failed to conduct a valid investigation in accordance with the law before announcing the said decision. MyCC, however, is arguing that Grab is jumping the gun since the Commission hasn't actually made a final decision and that Grab hasn't even exhausted the appeal process. Last year, the competition regulator said it was proposing to fine the ride-hailing firm for having abused its dominant position by imposing restrictive clauses on its drivers. It was to conclude its review on its decision within this year.